What if two people retired on the exact same day, with the exact same amount of money, and earned the exact same average return over the next 20 years? And one of them ran out of money while the other was just fine. Not a hypothetical. It has happened. It is happening right now. And once you understand why, it will change the way you think about retirement forever. Most people spend their entire working lives focused on one number: the size of their nest egg, how much they're saving, how much it's growing. And that makes sense. That number matters enormously. But there is a second number that almost nobody talks about, and it doesn't have anything to do with how much you save. It has to do with when the market decides to drop. Specifically, whether that drop happens in the early years of your retirement. That's what today's video is about. A concept called sequence of returns risk. Most people have never heard that phrase in their lives, but every single person who is retired, or who is planning to retire, is exposed to it. And understanding it could be the difference between a retirement that lasts and one that doesn't. So let's define it, because this term is important. Sequence of returns risk, sometimes called sequence risk, refers to the danger that comes from the order in which your investment returns occur once you start withdrawing money. It is not about your average return over time. It is about whether the bad years happen at the beginning, the middle, or the end of your retirement. And that distinction matters far more than most people realize. Here is the number that stops most people cold. According to research published in the Journal of Financial Planning, two retirees who both started with $1.2 million and both earned an average annual return of 4.7% over 13 years ended up in wildly different positions. Not because one was smarter, not because one had a better advisor, but purely because of the order in which their returns arrived. After those 13 years, one retiree had 16% more money available for future withdrawals than the other. 16%. Same average return. Same starting balance. Same withdrawal rate. Completely different outcome. That is sequence of returns risk in action. And here's why that surprises most people. We are trained to think in terms of averages. When a financial advisor says the market returns about 7% a year over the long run, that sounds reassuring. And over a lifetime of saving, it largely is. While you are building your nest egg, a bad year early on barely registers in the long run. You keep contributing. The market recovers. The average takes care of itself. But the moment you retire and start withdrawing money, the math changes entirely. Here's the thing. When you are pulling money out of a portfolio every single month to pay your bills, a market crash in year 1 or year 2 is not just a temporary dip. It forces you to sell assets while they are at their lowest value. And once you sell those shares to cover living expenses, you don't have them anymore. They cannot participate in the recovery. So when the market comes back, and historically it always has, your portfolio has permanently fewer assets available to grow back with it. This is the mechanism. This is how two retirees with identical average returns end up in completely different places. And the window that determines everything is the first 10 years of retirement. Research from the Center for Retirement Research at Boston College found that returns early in retirement have the greatest effects on future asset values precisely because withdrawals amplify the damage. And Vanguard's research on sequence of return risk confirms the same conclusion, that the threat is most severe and most consequential when poor market performance is concentrated in the earliest years of retirement. And this is where things get interesting. Look at what actually happened to people who retired in the year 2000. They walked into retirement at what looked like a good time. The economy had just come off one of the greatest bull markets in history. But then the dot-com crash hit, and then the 9/11 recession. In just the first 3 years of retirement, equity markets dropped 9.5%, then 13.6%, then 19.6%. 3 consecutive years of significant losses, right at the moment when their portfolios were at their largest and their withdrawals were just beginning. The damage from those early losses was permanent. According to data from the Journal of Financial Planning, A year 2000 retiree who took static withdrawals ended up, after 13 years, with roughly 10% less money than they started with. A retiree with the exact same average return, but who experienced those returns in reverse order, good years first, bad years later, ended up with 5% more than their starting value. That's a gap of 15 percentage points over the same time period with the same average return. The only difference was the sequence. And then 2008 happened. Another brutal early retirement scenario for anyone who had just crossed the finish line that year. The S&P 500 fell roughly 37% in a single year. People who retired in 2007 or 2008 were forced to sell assets at generational lows just to cover their grocery bills, their mortgage, their healthcare. Those sold shares never came back to their portfolios. Once you understand that, here is what it means for your household. First, being 100% in stocks all the way through retirement is one of the most dangerous things you can do. Not because stocks are bad. Over the long run, stocks are one of the best wealth-building tools in existence. But staying fully invested in stocks during the phase when you are drawing money down every month means you have zero buffer if the market drops hard in year 1 or year 2. You are selling your best assets at their worst price with no way to recover that ground. Second, the strategies that actually work are not about avoiding the market. They're about protecting yourself during that specific vulnerable window. The bucket strategy, used by many financial planners and endorsed by research reviewed by Charles Schwab and Vanguard, involves keeping 1 to 3 years of living expenses in cash or short-term bonds, money that does not need to be touched if markets drop. Your long-term bucket stays invested, recovers when the market recovers, and you never have to sell at a loss to pay next month's rent. Flexible withdrawal strategies are another tool. Rather than withdrawing a fixed dollar amount every year regardless of market conditions, you adjust modestly when markets are down, spending a little less, drawing from stable assets instead of equities. Research published in the Journal of Financial Planning showed that retirees who used dynamic withdrawal strategies rather than static ones ended up with 20% more assets available after 13 years of retirement and took nearly 10% more in total distributions over that same period. And delaying Social Security, even by a few years, functions as a form of insurance against sequence risk. A higher guaranteed monthly benefit that you cannot outlive reduces how much you need to withdraw from your portfolio during those critical early years, which is exactly when your portfolio is most vulnerable. According to the Center for Retirement Research at Boston College, 75% of financial advisors identify investment returns in the first 10 years of retirement as the most crucial factor to long-term retirement security, not the total return over 30 years. The first 10. Here is the empowering reframe. This is not a video about fear of the stock market. The market has recovered from every single crash in history. Average long-term returns have been remarkably consistent over decades. That story hasn't changed. What this video is about is understanding that there is a specific window, roughly the first decade of your retirement, where the math works differently than it does when you are saving, where the order of returns matters more than the average, where the wrong sequence at the wrong time can permanently impair a portfolio that looks perfectly healthy on paper. The people who understand this build a plan that accounts for it. They don't panic. They don't abandon equities. They just make sure they have a buffer that keeps them from being forced to sell at the worst possible moment. And honestly, that is not a complicated plan. It just requires knowing this risk exists in the first place. So here's the question I want to leave you with. Did your current retirement plan, or the one you're building right now, account for what happens if the market drops 30% in your first year of retirement? Leave your answer in the comments. I read every single one.